Danielle, thank you for joining me. And may I say that you look absolutely radiant
Thank
without
you.
getting the woke police, knocking on my door. And
We don't
also,
do
what I have to assume is that federal open market meeting weeks, FOMC meeting weeks, must agree with you. And I know you've had a busy,
they certainly do when the chair goes rogue. So yes, they definitely. I actually have a brand new nickname for him. So for Jay Powell.
I think we came across the same nickname. It's in my notes, and I think it relates to a movie, a Don Siegel movie with a big gun in it.
Yeah,
yes.
I call him. I call him Make My Day Jay.
Right.
That's so his funny. New name. Make My Day Jay.
It's so funny you came to that same simile. But anyway, so before we get to, we're definitely be talking a lot about Mr. Powell and the Fed, but I thought we'd talk about rainbows first. We both have a couple of rainbow stories, and I love yours.
Well, so it's funny that the day that the Queen passed away, there were of course multiple rainbows over Windsor Castle, over Buckingham Castle, and I tweeted out the photograph of it, and on my Twitter feed, I got a story relayed back to me from somebody who knew somebody with Prince Charles who was in the Air Force, and that his pilot
Prince Philip. It was Prince Philip, right?
Prince Philip, yes.
Right.
But his handle was Reign, REIGN, Beau, BEAU, as in the Queen's bow. Just one of the most romantic things I think I've ever heard, and that made it even more fitting that there were these multiple rainbows that sprouted up. It was just fabulous.
Such a cool story. I'm sure it had to be a coincidence, right? Couldn't be divine.
Don't believe in coincidences.
Well, to that point, so that really is a nice segue into my rainbow story. And first of all, I know you're a big history fan, but I don't think even you were aware of this little factoid from actually a Netflix documentary that they did on the major events of World War II. And of course, one of those was the Battle of Midway. And it was the second naval battle fought where the opposing fleets didn't see each other because it was fought with airplanes only. And the second one, because the first one was the Battle of the Coral Sea, which actually played a pretty big role because at that battle, which was kind of a standoff, the U.S. lost an aircraft carrier, the Lexington, and the Yorktown was badly damaged, but they were able to actually get it back in service a very short time later to have it part of the fleet that surprised the Japanese northwest of Midway. And of course, the only reason we were there is because of our code breakers, which actually they'd broken the code even before Pearl Harbor. They'd given a lot of warnings and we ignored it. But this time, and they actually did a clever ploy to prove that that was Midway that was the target. So the Japanese were stunned, but it was, again, only the second time the Americans had done something like this. So the coordination was horrible. So the poor torpedo bombers went in there without any fighter cover. They were slow moving. Most of their torpedoes wouldn't detonate. They were sacrificial lambs. I mean, one guy survived the actual attack. A couple planes somehow made it back, and he floated in the water during the whole thing. But the point of it is because they surprised the Japanese had their bombers on the deck ready to attack Midway. So when they had a certain kind of bombs for that, then they realized the fleet's out there, the Americans, so they got to change the bombs to attack the carriers. But now we've got the fighter bombers that have left, and again, complete miscoordination, which actually in a way turned out to be positive. So they're desperately trying to find the fleet. They don't see any sign of them. They're getting to the point where if they don't turn around, they won't have enough fuel to get back. And they see a rainbow. And the rainbow was caused by a lone Japanese destroyer, some kind of incidental ship that was lagging way behind the main fleet. And the American commander decided, okay, I'm going to follow this ship because I think he's going to go to the Japanese fleet. And they hit him at the perfect time. And it was just utter destruction. And really, the battle changed from America likely to lose and America winning a just resounding victory in 10 minutes, basically.
And so turning the war.
Certainly the war in the Pacific. That was one of
the war in the, yes,
the Japanese were
little known fact, I believe my grandfather's ship was being repaired when he was at Pearl Harbor. So he was on land when Pearl Harbor hit. So my grandfather.
He was actually there. Wow.
He was there.
That had to be. I'm sure he never forgot that. But
no.
You might not be here if it wasn't for that, right?
Good point.
Okay, well, you're here, and it's great that you're here, and I want to be the first to congratulate you. Well, maybe I'm not the first, but I want to certainly give you strong kudos for being one of the very first strategists to be out there making a recession call earlier in the year when many people thought, no way. And I was kind of in that camp for a long time. I shifted my view in no small part due to your viewpoints. And of course, now we're getting a little bit of sense that perhaps there's a bounce back coming and that maybe we are going to get a soft landing. And so anyway, I know it's pretty hysterical, some of the stuff that's going on in the market right now, even more than normal. Mm-hmm. So so the other analogy I've used for Volcker in some of his speeches lately is that he's actually Volcker. Powell has become this Volcker 2.0, if you will.
Yeah.
And you're nodding, so you obviously feel that's pretty accurate.
I think we've seen, Dave, I can't tell you how many dramatic things that I've seen here just in the last week or two, whether it's Jay Powell himself or what's happening in the markets or what's happening with jobs. So I think we are, after a very long period of wait and see and uncertainty, I think we are moving into some certainty that might not be very welcome.
We'll talk about the job. That's really a fascinating point right now. And, I know there are people that feel the data is supporting their case one way or the other, if they're believing that we're going to avoid a recession or we're going into a contraction. But before that, one of the things that, this was kind of like Midway came after the Battle of the Coral Sea. This Powell speech came after the one at Jackson Hole. And that was the first time he really, opened up the guns and let the market have it. And yet, I would say that one of the things kind of lost in all that hoopla, which certainly deserved, was the Chicago Fed report that came out during the same Jackson Hole conference, which basically said Powell's got a choice between accepting high inflation or a depression. And note, they didn't say recession; they said depression. So, what is your take on how likely that is? The starkness of his option set.
I would certainly question the basic premise, based on kind of very, very fresh anecdotal data. Morgan Stanley came out and said that its price rating for Carvana was going to go from $68 a share to a range of between $1 and $40, based on the fact that the company is probably not viable. The biggest driver of inflation coming out of the pandemic was used car prices, which is odd because they're not a very large part of the CPI. The biggest driver of disinflation right now is equally used car prices. This will be followed by financial stability report came out this afternoon. Lael Brainerd was the author of the report, and she's worried. She's voicing concerns about serious downside in housing. I think a year from now, we're going to be talking about whether or not we're seeing falling home prices nationwide reflected in the CPI. And because we're just now at the cusp of the layoff cycle, and we have seen wage inflation peak and come back down. It went from 5% year over year to 4.7% year over year in the latest payroll report. That's not only behind inflation, but it's turned and coming back down, including and especially in leisure and hospitality. It was the lowest paying jobs that were driving this fear of wage inflation spiral. So I would say that Powell has a choice right now to try and not create a depression, actually, because I think that the period that we're in right now is such that so few people are expecting what's happening and what's going to happen that I think they could be taken by surprise.
Well, housing is certainly critical, and I do want to talk about that for sure. So it sounds like your view is he doesn't have to accept this trade-off, this very scary, almost like
he doesn't have to accept the trade-off, but if he wants to do what I think he really wants to do, he's a practical man. He's a lawyer. He understands that certain prices have turned around and come back down. He understands that many people in white collar professions have lost their jobs. They're receiving severance packages. This is not your typical layoff cycle that starts at the very bottom rungs of the income ladder at all. It's starting at the very top with severance packages that will run out. So I think that what he understands is that he's able to hide behind the guise of the lagged effect of housing as it moves through the CPI. I think the next 2 or 3 or even 4 CPI reports you could see be hotter on the housing side because of how slowly house price gains from months ago are just now manifesting in the CPI. And I think Powell knows it. But
Sure.
if he's trying to break the Fed put, if he's trying to give the control back to policymakers instead of leaving the control in the hands of investors to make monetary policy, that's a whole different level of challenge. It's very Volcker-esque. It's Volcker-esque
Right.
in the face of retreating inflation.
Yeah, and I think that's a critical point. But to go back to another critical point you just made, which is the severance package aspect, which is, as I understand it from reading some of your material and talking with you previously, that the severance packages throw off they don't get picked up as unemployed until the severance packages run out. Is that correct?
That's part of what's going on, yes. And because a lot of these people are getting such big severance packages, they're like, well, why do I want these state unemployment claims? That's like a pittance compared to what I'm getting. We will see them show up. And in fact, if you look at the week ended September the 24th, jobless claims nationwide were down 49%. That was like as good as it got. Down is good when it comes to jobless claims down.
Sure.
As of the latest week, they're down 23%. And now instead of just 1 or 2 states with rising unemployment claims, 20% of states have rising jobless claims. And you do see a softening of the effect with severance packages, but you've seen job openings in business and professional services absolutely collapse. And that is reflecting those white collar positions that are being wiped out. And just because there's severance attached to them does not mean that they're going to be able to get income to replace that once this severance period runs out, if we're in as deep of a recession as I think we're headed into. So then you'll have a real problem on your hands to not have high income individuals be able to pour back into the workforce. That will be a massive challenge.
Mm-hmm. Makes sense. And the other key point you were making is the fact that the Fed, they're obviously very focused on the jobs market, and they're also very focused on inflation. And one of the problems is those are 2 of the most lagging indicators out there. But again, you would say Powell is fully aware of that.
Yes.
He's using that for cover to try to eradicate that Fed put, the Powell put that he no longer is a supporter of. In fact, he's actually quite the opposite. So where do what do you think his pain point is? I mean, he's obviously going to. You've told me this before. You think he's going to raise rates to a high level, but the big thing is he's likely to leave them there longer than the market is anticipating.
Yep, that is right. And I think that you have to explore what the consequences of that are. I'm going to go back to Carvana for just a second, and trust me when I say I'm not solely focused on Carvana. It's just such a timely example. Because subprime delinquency rates on cars are near their record highs before we really kick into the layoff cycle. So, and used car prices are falling so fast, but what Morgan Stanley also mentioned was that they were having trouble accessing financing. Now, if you bring rates up to a high level and keep them there while you're shrinking the Fed balance sheet, while the system is being depleted of liquidity, there's a very good chance that banks are going to run out of the lending capacity to keep open securitization in the way that we've had it be so accessible for so long. That Armageddon scenario was prevented in 2008 when Bernanke came riding to the rescue. The commercial mortgage-backed securities market opened right back up. Right now, if you're trying to finance commercial mortgage-backed security, your borrowing costs have tripled since March, tripled, if you can get the deal done. And we have a record 95% of investment grade bonds trading at a discount. So, keeping rates high when you're going to be running into maturity walls starting in 2023 is going to be a very dicey proposition. And we'll see if Powell can carry it off and have it appear as manifest as a controlled demolition that really takes the zombies out of the system. And also takes away some candy that Wall Street's had for a very long time. Wall Street's had the ability to have any kind of structured product leverage. They've had the ability to have garbage underwritten for a generation. And, you know, if he's able to take things away one at a time and not have any kind of contagion effect, not have a daisy chain breakout, then I think he's going to keep the pedal to the metal.
I think you're right. So you're saying his pain point is if things really start to blow up. And that's one of my big fears, is that you have so much debt out there. You've got so many complex securities that have been created during this artificially suppressed interest rate period as people desperately try to create yield somehow. Mm-hmm. And then the connectivity of it all, that if you we don't know. I've seen some just staggering numbers as far as the actual amount of derivatives that are out there. I mean, in the hundreds of trillions. Of course, that's a gross amount. It's not a net amount. And people say, you got to net these things out. But what we found out in the last crisis, and I think we're seeing in England right now, in the UK, is that in a crisis, all of a sudden, it isn't so much the net, it's the gross, because you really can't trust your counterparties that you think you've laid a risk off to. And that's when things can really get nasty in a hurry.
I mean, it's patently apparent that it wasn't necessarily the level of gilt yields or where the pound was necessarily. It was that BlackRock said, we can't price these structured products that we've sold to these public pensions, and margin calls had to be satisfied in cash. Now, U.S. public pensions, and this is a really important distinction to make, U.S. public pensions can satisfy a margin call with securities. UK public pensions had to go out and sell properties, illiquid properties,
right,
in order to raise cash. The only thing that they could satisfy margin calls with was hard, cold cash. And so you saw this contagion effect immediately. So, but that is not to say that the same structured products that were sold to British pensions, were not also sold to US pensions. So the risk is definitely there, because the only way to create yield has been to synthetically somehow manifest it with leverage.
Absolutely. So for our listeners that don't really understand what we're talking about, there was a big blow up last month in the UK pension system where they were loaded with LDIs, liquidity driven investments. That sounds like such a benign product. But in this case, it magnified illiquidity, as you just described. And this factoid I came across actually from, I believe it was Jim Grant, that 82% of the Bank of England's own pension plans were in LDI products. But I guess they're kind of bailing them out, without too much publicity.
Oh, but the irony.
right up there with Ben Bernanke just winning a Nobel Prize in economics, right?
That's beyond irony, but okay, yes.
But he had the Courage Act. We know they had the Courage Act. But in fact, maybe this is a good point to talk about. I don't know if you ever see the Babylon Bee, but they did you see their key job requirements to work at the Fed that they just put out this week? You had a really busy week. You've been on the road. You've been back in New York, recording TV shows like crazy. But some of the ones that are pretty funny is they've got to be up to date with all 20 COVID boosters. They'd had to change an ink cartridge on a money printer. All fingers and toes for counting purposes. Little to no knowledge of economics, basic math required occasionally. Ability to go on TV and look concerned whenever there's a recession brewing. Must think Paul Krugman is the greatest living economist. Must be proficient at doublespeak, always leaving ambiguity in your words. Experience with blame shifting. That's one of the most important to be in that role. Able to sound 2,000% certain about something that is about a 5% chance of happening. So, I think actually Steve is going to post these, so we'll be able to see them.
That's a riot.
Listeners will be able to see them. Yeah, that's pretty appropriate. So, speaking of the Fed and getting back to Mr. Powell's Dirty Harry impression this week, some of his words were pretty emphatic. They some of them, I'm paraphrasing a little bit, rates need to go higher than previously thought. It got further to go, rather over tighten than under tighten. Can't correct the former. Very premature to think about pausing. I mean, it was a double barrel blast at the market optimists.
Yep.
And yet the market, anything that looks like it could lead to a pause or a pivot, preferably the pivot, but realistically, you got to pause before you pivot in this environment anyway, with this new attitude. So what do you think? What do you think is, I mean, you mentioned that it's going to be probably a major break in asset prices that gets his attention, but what about in terms of unemployment? I mean, even though it is lagging, I mean, if it hits 5%, is that a level that would really alarm him?
I think it would, but again, he was publicly called out by Sherrod Brown, by Senator Sherrod Brown, in an open letter, and Sherrod Brown said, "You must pay attention to your employment mandate." And one of the key things that he said at the podium, Dave, was that with respect to both of the mandates, satisfying both of those mandates could only be done if he got inflation under control. So he actually answered the politicians in one fell swoop at that podium, dismissed the politicians, saying, and he's been maintaining this, but he actually specifically articulated it for the first time to answer the people who want for him to pause or pivot. He said, it's more important for employment in the long term if I get inflation under control. He's got the narrative down pat. And right. Again, he's a wise enough soul to know that, apartments.com, 1 and 2 bedroom apartment rents, they've turned negative for the first time since prior to the pandemic in the last month. He sees all of this practical data. That doesn't matter. He knows that the economist you just described, the job description you just laid out, he knows that somebody like that created the consumer price index such that it won't reflect true prices in the marketplace for a very long time. So if it's inflation that's going to be more important, yes, he will sustain a rising unemployment rate. And I think that that's what he is saying when he says, we're going to have to go through some pain, quote unquote.
Yep. And to your point about housing, and not just rents, but housing prices have now been falling for at least 2 months in a row, right? Mm-hmm. I think it's actually more months.
Yep. And it's becoming much more widespread, and it's happening so much more quickly than it did in the aftermath of the financial crisis. I think there's a false way of thinking about house prices because there was such a focus on Boise and Austin and certain Nashville, certain areas of the country that people are saying, well, they had bubbles there, so therefore the rest, we cannot have nationwide home price declines again. That's going to be something that is isolated to the era in which we had subprime mortgages. And yet Invitation Homes, spun off by Blackstone, biggest holder of single family rentals in the country, just said that they were going to miss their estimates because they came out of left field. I could have told them, but they didn't ask me. But because of rising, they should have, because of rising property taxes in the state of Texas, they missed their numbers. And so there's so much speculation that's been poured into so many markets, especially driven by the zero interest rate policy that's fueled investors, fueled the Airbnb jocks, that I don't think people understand how widespread this housing downturn is going to be. Just because you don't have the big short and a stripper to pull with 5 mortgages doesn't mean that there's no leverage in the housing market. It's just taken on a different form, and it's different individuals this time around, but it's there.
Sure. Yeah, absolutely. It's there. In fact, one of the things that I really worry about going even beyond, of course, with the US alone, housing has such a big impact. It's a huge footprint on the economy with all the derivative.
About 20%.
About 20%. That's a big number. But then also what's happening overseas, because as we learned in 08, 09, it's a global housing market, and the ramifications from a global housing bubble bursting is huge. And that's what shocks me is that when you look at the magnitude of the housing bubbles in countries like Australia and Canada, and even some of the Northern European countries, it's far greater than the United States, which is bad enough. I mean, new home prices in the United States have basically doubled from 08, 09. Now you could adjust for inflation, would be quite, but still, it's a shockingly big increase. So how worried are you that we could have kind of the, a repeat of, maybe banks are in better shape, that type of thing, but still, I got to believe there's a lot of products out there that could blow up in a global housing bubble implosion.
So you raise such a salient point, Dave, because even though the United States is the largest economy in the world by far, when you start to add up, all the Nordics, just every last one of them, Germany, South Korea, Australia, New Zealand, Canada, home prices in China have fallen for 13 straight months. I don't think, regardless of what a post-COVID zero policy looks like, and by the way, it doesn't look like much now. I mean, they were slamming the gates of Shanghai Disneyland on Halloween Day. They locked people in the park. They've got two major companies right now that are in lockdown. Foxconn with 200,000 employees, and I think it's NIO, one of their electric vehicle car makers, is also in lockdown right now. So for all of the policies being lifted, my good friend Leland Miller is not of the view that it's going to be something that magically happens overnight. All of this being said, it's not going to take the form of a major turnaround in the property market in China. And that's material for the global economy, because the government has attempted and failed 3 times prior to try and wring some of the speculation out and the over leverage out of the property sector. I don't think it's going to give that progress back, even if you see steel mills start to fire up again and their supply chain heal and a more robust export sector. I don't think necessarily, to your point about global housing, that we're going to see any magnificent recovery. China's just seen the first decline in population in the latest in the latest figures. So that's something that they're going to be highly cognizant of. And at the same time, you've got all of these massive recessions in Europe and housing bubbles bursting throughout all of these countries where they're magnitudes of what the United States was in 08 and 09. I think that I don't think that people appreciate the globality of what's happening right now being of a greater magnitude than what it was in the financial crisis.
Right. And based on that, this belief that if we do have a recession, it's going to be short and mild, I just don't think that squares. I think that's kind of magical thinking. And I can tell you agree with that.
The other thing we haven't really touched on is commercial real estate, and A, financing is impaired, but B, there have been structural changes to the commercial real estate market. And these office buildings are never going to fill up. Some of these hotels that cater to business people, they're never going to recover. And we've got 900,000 multifamily units that are coming out of a construction pipeline in the next 12 months. That's a 50-year high. We have more single-family homes under construction than we've had since 1974. There are some structural issues right now that are going to affect commercial real estate and residential real estate that are going to take years to work through. Years, plural.
Well, on your point about commercial real estate, speaking to office buildings specifically, I just reread in our mutual friend David Rosenberg's piece that the vacancy rate in office buildings nationally is over 50%.
Mm-hmm.
So
that's extraordinary.
It is extraordinary.
And
extraordinarily concerning.
And I understand the whole work from home phenomena. My company's been work from home before it was an acronym. I understand that, but there's also been an extraordinary level of automation that's gone on in the background, and there's been offshoring of white collar positions. Boeing just sent 100 finance, just hired 100 finance individuals in India. They fired 100 people in finance at their main headquarters. These are relevant things. Work from home taught employers a very valuable lesson. If you're talking about a P&L, it taught them that if they can leave Palo Alto and go live in some suburb of Denver, or wherever they want in the country and do their job. That work from home individual can be anywhere. And so
Right.
whether you're talking about architects, paralegals, people in finance, as I just mentioned, accountants, these are high paying positions, white collar positions. And because companies got so burned by wages going up so quickly and the entitled attitude that so many workers had, there's been a lot of very quiet offshoring. And those jobs are not coming back.
Well, since you brought up jobs, one thing that I meant to throw in there, we were talking about that earlier, that is quite supportive of your viewpoint, is the Challenger survey. Because again, the jobs market, the number today look pretty good superficially. But as we said earlier, there's nothing more lagging other than perhaps inflation than the employment market. But the Challenger survey is much more anticipatory, correct?
It is, and there's even something that anticipates the Challenger survey. And since the pandemic broke out, I've discovered this website, dailyjobcuts.com. It's as simple as that, dailyjobcuts.com. And it just keeps a running tally of, Stripe announced that it was going to lay off 1,100 employees 2 days ago, or Amazon came in there, Microsoft was in there, Intel a few weeks ago. But it just keeps a simple running tally of what's been announced in the same way that Challenger does, but on a daily basis. And so far, we're just 4 days into November, but so far you've got as many job cuts that have been announced almost as what were announced for the entire month of September.
I just saw that in your daily quill today, which, by the way, I want to plug that and let everybody know that that's one of the things that I read every single day. It's a great way to stay abreast of things, and of course you think in a very non-consensus way. So it's great to get that, because so much of the stuff that we tend to read is, it just seems to be happy talk more than, solid research. Well,
that's their job. Happy talk keeps people on.
Well, speaking of talking, you were on the Charles Payne show. Was it at least once this week? Was it twice? I know once with Chris Lowe.
It was once this week, but I like what they do. Actually, we beat out CNBC 4-1 2 Fed meetings ago. I'm waiting to see what the ratings are for this last one, but he typically brings me in right before Powell hits the podium, and then about 20 minutes after, when inevitably the questions become redundant. So yeah, and I was with Cavuto as well, but Charles actually thought I was going to jump out of my chair, because I was so electrified. I was so astonished by when Powell first was asked the questions, he was literally reading from a script, and he was reading answers to questions. And at some point, something just went snap, and he just went rogue, went right off script. He started answering things. And the more he was himself, it was like the opposite of watching Joe Biden. The longer he was unscripted, the better he got. It was just incredible.
No argument for me there. Well, that is so different than the way he used to be, for sure. And as you know, in the initial, before the presser, I guess it was just the release of the minutes that the market was rallying. It wasn't the minutes, but the actual,
they included the word lag. He placated the doves. It's as simple as that. And then he proceeded to trash all of the academic research on the body of work of lags at the podium. It was extraordinary. Yeah,
he seemed to be dissing the economists at the Fed.
He called them the economists over and over again. He was like talking about them, those people over there. He's not a PhD in economics, but he kept saying the economists. I've never seen anything so patronizing in my life out loud. I mean, I've always been that way about the Fed, but to see a sitting chair behave that way. But these are the same academics that led him down the transitory rabbit hole.
Exactly. I mean, he's got to be angry at those guys after what the position they put him in last year.
Of course.
But another interesting thing about that meeting is that this is the second one, at least this year, where, as you know, over the past few decades, the stock market has risen repeatedly. I don't know if you've ever seen any of the charts where if you back out the market, just look at the year, other than Fed meetings, the returns go way, way down. So, and that's been true even if the Fed raises at a given meeting, the market still rallies, but not in August and not this time. So that's another pattern that seems to be broken. And I think that's exactly what he wants to do. You and I both sorry, go
But,
ahead.
but we're still seeing valuations very, very high. I think he feels like when it comes to financial conditions, I think he feels like he's got a long ways to go.
I totally agree with you. And I think that's why the market, every time it tries to anticipate a pause or a pivot, and that could be eventually peak inflation, that it just gets slapped back down again. Because when it rallies hard, that's exactly the opposite of what Mr. Powell wants to see right now.
That's right.
And I don't see that pattern changing until the news gets really tough. And so I guess if we were to fast forward a year from now, and let's assume that the Fed funds rate has been pushed up. I knew when you were on with Chris Lowe on the Charles Payne show that he was saying he thinks we're going to get to 6% on the Fed funds rate, and you kind of blanched on that one. And I think your view is he's going to have a hard time getting there, which I actually would agree with.
I think something will. I think something will seriously break. I mean, we're seeing. I mean, I just with what's happening with CLOs, junk bond issuance, not junk bond spreads, but junk bond issuance. I mean, there was paper floated today for 12%. I mean, it's at some point it's going to get pretty hard in this environment when you think about junk paper being sold for 12% when we're not even quite at 4%. So,
well, it's true. The CCC index hit 16% fairly recently. That's a big number, even if you adjust it for defaults.
right. And again, I mentioned this earlier, the fact that investment grade paper, so much of it is trading as if investment grade companies are going to be defaulting at the fastest pace since the 1980s. That's just extraordinary. And it goes to show you that the rating agencies once again are going to be playing a game of catch up. That won't be subprime bonds. It'll be corporate bonds. But last time that happened, Jay Powell came in and indemnified the BBB sector when the pandemic hit. I don't see that repeating itself.
Yeah, what's going to take, we've talked about that before, that's going to take a serious convulsion in the corporate bond market to get them to do that.
I think you could theoretically break an exchange traded fund, and that could be an event that I think would prompt him to ride back to the rescue.
Because that was their hugely successful ploy during the pandemic. And, you know, I thought that was what they would do in the next crisis. That was clearly the mother of all crises. So it gave them the cover to do it. But now there was a law change, right?
There, yes. So Pat Toomey, who is, unfortunately, I should never say that. Pat Toomey, fortunately, has committed to term limits and is abiding by his commitment. So he's leaving office in the state of Pennsylvania. And that's why you have this kind of Looney Tunes show going on in their Senate race. But he also made sure that verbiage was included in the final stimulus bill that Trump signed into law, because he had an aim at the Fed's municipal bond facility, which of course immediately helped bail out some aspect of the state of Illinois. But Pat Toomey wanted to make sure that the credit facilities that had been opened in conjunction with the Treasury, which was kind of an effective leverage buyout of the Federal Reserve by the Treasury, to have these off-balance sheet vehicles up and running, these credit vehicles on the Treasury's balance sheet. That was a great big illegal no-no. But Pat Toomey made them, he had them turned off and wrote into the law that any future Fed chair could not just turn these credit facilities back on without a new, unusual, and exigent circumstance. There had to be a fresh emergency that was thereby approved by Congress before they could even thinking about turning these credit facilities back on. So it won't be, especially with a divided Congress, it will not be something that can be quick unless there is a complete meltdown, in which case any politician will do anything.
Well, that's what I believe, but I think that we probably will get that meltdown. I mean, from all the things that we've talked about, particularly the housing bubble, which is very much, as you said, a global phenomenon. So there's really serious stress building. And, looping back to the situation in the UK, so I listened to an interesting podcast with our mutual friend, Grant Williams, Bill Fleckenstein, and James Aiken. I don't know if you know James, but real expert on money markets and brilliant guy. And his point is that this, it's kind of the cockroach theory. There's never just one. And that what happened in the UK is going to happen in other places. And that actually leads me to, I actually just read this line in because you wrote on this whole guilt thing. You said averting a guilt trip. Wasn't that the title to your
Averting a guilt trip? Yes.
I love that title. That's a great title.
Blind squirrel.
But I want to look at my note on this because I don't want to misquote you, because I found this really a chilling line, and this was your closing of that note. Public pensions present as existential a threat as exists to economies and the global financial system. And that's a pretty powerful sentence. In fact, that's almost like are you a ghostwriter now for Jay Powell? It's kind of like on a par with what he's been saying lately.
No, look, I think that the public pension system has never really had the reckoning, but going back to the idea of keeping rates at a high level, if you think about the trend in pensions towards alternative investments in the last couple of decades, they've increasingly piled into illiquid private investments. Every time we've had an episode like this, the Federal Reserve has been able to come in within a reasonable time frame, a couple of quarters at most, and prevent the pensions from having to write down, because the private equity firms don't have to write them down. They can buy a little bit of time.
Sure.
Because these are they're private valuations. But if they don't have those couple of quarters of cover, and if Jay Powell succeeds in keeping interest rates high for a long time, and public pensions who've already taken a beating on their public holdings have to start writing down their private ones, there's nothing in the Constitution of the United States that allows for a state to declare bankruptcy. Nada. So, and Illinois is on the razor's edge, as is New Jersey, Connecticut, Kentucky. But this, to me at least, because they've had to search for yield to try and pretend that they can match their assets to their liabilities, because of the machinations, the crazy things that they've done that are highly inappropriate when it comes to setting aside money for grandma and grandpa. I think that it could be the thing that is both financial, economic, and societal in nature.
I think you're right. I think it's an absolute disaster in the making, and there's quite a few other ones out there as well. One thing that's interesting that perhaps, well, let's talk about the yield curve, because that's something that, pretty consistently Jay Powell has ignored, at least publicly. Now, you and I would agree he's smart, he understands that. But what he's used as his cover for that, complacency is his favorite yield curve indicator, which I believe is the 3-month versus the 18-month, threes versus 18s.
Yep.
And he was even asked this week about how that, which was quite steep not too long ago, is now basically right on the edge of inverting. And given the future trend of the Fed's rates, I mean, it's almost a lead pipe cinch to invert. So isn't that, forgetting all the other stuff we've talked about, isn't just a yield curve inversion alone, especially since the curve is becoming more inverted, isn't that like kind of open and shut case for a recession?
So, I found it to be fascinating because in the past, he has just said yield curves don't matter, and he at a press conference, and then he moves on. But this time he's talking about across the entire yield curve. And I'm like, wait a minute. You wouldn't even give this thing lip service a few meetings ago. And now you're talking about across the entire curve. So you're acknowledging recession. Bless your heart. It was a complete change of attitude and approach towards a subject about which he'd been very dismissive. On that same exact note, he basically was a one-man dot plot. I've said this a few times. Since September, basically the terminal rate has increased. He's not allowed to say that. That's actually a big no-no. You don't speak for the committee. You let the summary of economic projections only when they're released in December, not in the November meeting. And yet he threw it out there.
So I heard you say on the Charles Blaney show that you think that he's personally moved the goalposts. Is that an example of what you're talking about?
It's exactly what I'm talking about, is that he said since the September meeting. And that was not kosher. That was, you're not supposed to do that. And if you go back and you read the transcripts of prior press conferences, when he was first talking about the dot plot, he absolutely thought it was garbage, which I still think he thinks, by the way. And how in the world can we tell you what the world is going to be 18 months or 2 years from now? And yet now there he is being a dot plot of one. And having and speaking as if he's a fully autonomous monetary policy making machine. I mean, maybe we need to get rid of Clint Eastwood, or maybe we need to bring in the Terminator or Rocky. I don't know.
Well, he's becoming like Xi Jinping, who you also wrote a note about here recently.
Yes.
The autocrats do seem to be in charge. Well, you said garbage just a moment ago. So that triggered in my mind something that I consider to be sheer garbage. And it's very important to most of our listeners because it has a key role to play in the valuation of the stock market. And that's 2023 earnings estimates, which I'm sure you've looked at and said, what are they smoking? I mean, I know it's legal in a lot of states, but shouldn't probably be doing that when you're creating earnings models. So you agree it's Looney Tunes.
Well, especially because, you know, some of your most highly valued sectors are one and the same with sectors that have the most exposure overseas. And, you know, with Europe as weak as it is, these tech valuations to me are just, they're smoking something. Because we know that the rest of the world is going into recession more quickly, perhaps, than the United States, at least, especially in the case of Germany. We don't know in the case of China, but we can make that assumption. But even if you're talking about, you know, bellwether South Korea, Taiwan, it's happening so fast.
It is, and yet, you know, things don't go in a straight line. It's like the stock market, you know, it inhales and it exhales. And so some of this economic data almost looks a little bit better here lately. But, you know, in my experience, and I've been doing this about 43 years, you do get a lot of cross currents at inflection points. And, you know, some of this data can be noisy. So it's, and I guess
2.8 percentage points of the 2.6% increase in GDP in the third quarter was exports.
Exports.
Okay, fine. We export a hell of a lot of natural gas since Putin marched. There's
Right.
a new flash. I mean, it's, yes, there are, but the other, you know, the flip side of it is, I don't think that we've seen very many residential real estate prints that were as deeply in the red as what we saw in that GDP report. Absolutely extraordinary.
Well, have you ever studied, this is kind of an interesting analogy, or just a historical parallel, but the 1937 bear market recession?
Well,
I
wrote for that. Yeah.
So you're, because that was, for people who don't know, it was a very strong economy coming out of the bottom of the recession. It was a very strong stock market coming out of 1932. Yep. Then 1937, the Fed decides to take the punch bowl away. And it was a very tough, I think the market went down roughly 40%, and there was another kind of mini recession within the overall Great Depression. But an interesting parallel with that was that's the only other time, at least since that, might have been one earlier in the 30s, where there were 5 consecutive months of 7.5% fluctuations in the stock market. Which
I might have seen that graph somewhere, Dave.
Yeah, that's that was a rough period. I mean, and I do think there are, you know, parallels, as I said a moment ago, with that period, and that you've had this, you know, very healthy recovery coming out of it. Wasn't the Great Depression, but it was the Great Pandemic, and this terrific recovery. And then, you know, there was the reason I ran that graph was more for the punchline that stocks never regained their 1929 levels until 1954. Right. And that was that was the price tag for 1937. Exactly. And kind of where I'm going with that is this belief that, you know, we've kind of flushed everything out. You know, we've had this garden variety bear market, at least outside of tech. Tech, of course, has been hit harder, but it was much more inflated. So there's a belief that, you know, the worst is over, and let's just look for that moment when we can actually go all in and we get the new bull market. But my belief is that right now, all we've basically discounted is this sharp, I mean, really almost unprecedented outside of the early 80s rise in interest rates. I mean, that alone, you would think would have the market down 25, 30%. Then if you're looking at what could be almost for sure is going to be an earnings recession. I think, in fact, if you look, as you know, if you strip out energy, we've already got an earnings recession underway. Then if we get a truly serious recession, not this, you know, kind of softish landing type of thing that could be considered a growth recession, I think there's a lot of hopes we'll have, you know, basically a growth recession. I doubt that you believe that. I doubt you believe the stock market's fully discounted the problems that are out there.
No, and in fact, you know, when you look at the latest from FactSet, which I think has Q4 coming in at negative 1.1, that kind of the first true negative print, fully incorporating energy, of course. But if you look at where we are just in the earnings season right now at 2.2% for the third quarter, retail hasn't reported. So we still haven't seen.
Just wait.
We still haven't seen, the hardest hit sector of the economy report its earnings yet and or give guidance. So I think that there's this illusion out there in terms of we might avoid an earnings recession that I think that is going to be deeply disturbed. It's going to be like a rubber band snapping back when they wake up and go, oh, wait, we might have 2 or 3 consecutive quarters of negative.
Exactly. And so that's where I think when you're going to get the second down leg in the stock market is when that kind of epiphany occurs.
Mm-hmm. And with it, companies pulling back on share buybacks as well. So because when these things happen, they tend to be compounding in their effect because companies batten down the hatches. They try and hold on to their cash. They do what they should. We're seeing the bankruptcy cycle really kick into a higher level. We're going to now go past in the next few weeks the level of distressed debt on hand. It's going to start going past the highest levels of the pandemic. This is all building in the system. Distressed debt meaning trading 1,000 basis points or more over a comparable treasury. So that's well beyond the CCC realm.
In fact, something you said triggered my mind, something I had thought about before, which is because I totally agree with you that buybacks are, they were a huge inflator of the equity bubble of the last 12 years or so, 13 years. And, in fact, one of the chapters of my book was about buybacks, that they were going away. But they had a comeback. I mean, in the last, post-pandemic, there was a lot of buybacks once again. During the pandemic, when their stocks were really cheap, of course, they didn't buy back shares. In fact, they were selling shares. Yep. It's the typical wrong way Corrigan way that companies so often behave. But right now, to your point about how many bonds that are selling at deep discounts, would actually make more sense for these companies to do bond buybacks than stock buybacks at this point.
That is absolutely correct.
Yeah, I think that's something that we really haven't seen that too often. I mean, occasionally you'll get it, but we could see a broader form of that coming up. So let's talk about QT, because it's amazing to me that there's, and maybe it's just because Powell's had such a radical 180 and all the focus on how much they've raised rates, which is certainly a big deal. But QT is a big deal too, even though it's had a slow start, but now it's really kind of kicking into full gear.
Yeah, I mean, we got the latest H4 that that incorporated the Halloween day maturity of treasuries, and that was $45 billion in 1 week, just like that. So QT is up and running, and it is depleting liquidity from the system, and that is what we're seeing manifesting in the credit markets. And that is your transmission mechanism from point A to point B. And I think we have to anticipate that it's going to play a bigger role, and it also will assume a greater level of the tightening going forward if Jay Powell means to get the terminal rate up to 4.5%, 4.75%, 5%, whatever you want to call it. The marginal tightening of monetary conditions through the rate hike channel is going to be dissipating. But if he keeps QT going in the background and he holds rates high, that's going to feel, you'll see bankruptcies just go skyrocketing.
I would think so. And so this is a little bit of a tough and maybe even unfair question, but they're on track supposedly to do QT to the extent of about $1 trillion. So what that really means is they're going to be shrinking their balance sheet, basically buying back bonds to that tune, selling bonds to that tune. So they're actually sucking money out of the system. Mm-hmm. So what do you think that $1 trillion roughly equates to in terms of rate increases? Again, I know that's a more art than science type of question, so don't feel like I'm trying to make you come up with a precise answer.
Well, so I actually used to kind of have a stock answer for every 250 billion, or for every 500 billion, you might consider that to be a quarter point hike. I don't think that the old body of literature applies because of the damage wrought by the swiftness and the magnitude of the rate hiking cycle. So I think I think tightening at the margin is stronger than it was when we saw rates being increased by 25 basis point increments in the first round of quantitative tightening. Now we're seeing it at 3 times that level with QT going on in the background. So I think it's extremely hard to assess. I'm not trying to avoid it. I'm just saying if it was 25 basis points for every $500 million last time around, it might be a full point at this point.
Interesting. That's a very interesting point. I hadn't thought about it that way.
Well, you have to look at it against the backdrop of cumulative tightening. And cumulatively, we're doing a higher level of QT than we ever have per month. And the rate hiking cycle has been completely compressed since March. So QT matters more now at the margin because you're already so tight with monetary policy conditions.
Very good point. So this is actually something I got from that James Aitken podcast as well. That's a little bit whimsical, but actually meaningful too. And this is the role of Nick Timiraos from the Wall Street Journal as the Fed whisperer.
Mm-hmm.
And Aitken believes that because he did this New York Magazine interview where he kind of was puffing his chest a little bit about being the Fed's guy, that angered Powell, and he's, according to Aitken's and his charming Aussie accent, he's now on the naughty step. And that there's a new New York Times journalist, Gina Siomak, I'm mangling her name, Smiliak. Gina Smiliak, and that she's now the new one that's got, as he says, the Fed's drop. And what's interesting about that is if you look at the article that Timiraos wrote before the Fed meeting, it was basically kind of a dovish one. He certainly wasn't expecting the kind of reaction that Jay Powell delivered. But if you listen to her, she was much more like, no, the Fed is really concerned about inflation. They're concerned that the output gap is not as great as they thought it was. And she basically warned that this was going to be. So it's an interesting, because many of us have focused so much on what he said, because he really has had he's been the Fed's whisperer for, since Greg Ip was in that role a number of years ago.
And then John Hilsenrath after him.
Right, that's right. Hilsenrath after him. Good point.
And the thing is, I don't know Nick personally, but I will say that the cat was kind of, you used to be able to kind of call it a guessing game and maybe not recognize it. But when Nick was sent out during blackout to broadcast that the Fed was going to be pushing for 75 basis points instead of 50, they might as well have put a target on the back of his head, because that was something that was done in such an obvious way as to, you would start to question Nick's integrity if he didn't at least in some way recognize the role that he had played. Then he would just be seen as, just a patsy. And I mean, I can't believe I'm sitting here defending Nick, but again, I don't know him from Adam, but he was put in a very compromising position to have to come out a few days before a Fed meeting and move the market's anticipation from a 50 basis point rate hike to a 75 basis point rate hike.
Right.
So here we sit.
It was just too obvious in that case.
It was too obvious, but it was something that he was prompted to do.
Mm-hmm. Sure. That's, every one of those kind of deals has its downside when you make a little bit of a Machiavellian bargain like that.
Right.
Well, our listeners have been so excited to have you on our show that they've been emailing me a number of questions. We have a little bit of time left, so I thought I'd go over some of these questions and get your reaction to them. But you do have a lot of fans among the Haymaker following. So first, this one's from Dan Amos, and apparently you did an interview with where actually Jim Rickards, I believe, interviewed you at Bretton Woods. Is that right?
It was at Bretton Woods. It was extraordinary. Yep.
So Dan Amos wanted me to, for sure, he was very impressed by your take on the auto financing market that you've talked about a little bit today, but he wanted me to ask for your updated thoughts about that, and particularly when it comes to subprime auto financing. And he believes it's bearish for the entire auto supply chain. Is that something that you would agree with?
It is. In fact, just a few days ago, I saw an auto supplier announce that it was going to be closing a plant in the Mid-Atlantic region. And I do think that once you satisfy the backlog and put the few semiconductors that are missing back in these vehicles, and once you get through 1 or 2 months of pent up demand because I've been waiting for this particular new vehicle to be on the lot. I think you will see a major ripple effect back through the entire production chain, if you will, of manufacturers. It's been extraordinary to see the catch up. Mexican exports went through the roof, and that is because they're no longer missing pieces. But once we get through this, and it appears we're getting through this very quickly, then I think the backlash is going to be absolutely brutal. And
so just to be clear, the reason you're saying Mexican exports, because so much of the U.S. auto assembly production occurs in the so-called maquiladoras that are along the border.
Exactly. So when you saw this massive healing in that particular juncture of the supply chain, I said to myself, we're not going to be talking about undersupply in autos at all within a matter of months. But by the same token, to his question about 60-day delinquencies, they've continued to rise. Repossessions are finally increasing. AutoNation, Carvana, these other, they're all canaries. They're all canaries. Whether it's Ally Financial, Capital One just increased their allowance for bad car loans to 3.5% in their most recent earnings report. That sent that stock down. So I think that the process can no longer be hidden now that we've had so many publicly traded companies have to disclose what's really going on. And now we will see, I think, a faster repossession, faster auction pipeline, and rising delinquencies. It only takes one lender out there to really clamp down on their delinquent borrowers for the rest of them to get the word. So we should be seeing delinquency rates climb very quickly.
When you think about it, we've already talked about the disaster in housing, but also now if you have the auto industry going into kind of another recession, because really they've been in a volume recession for the last couple of years, even though they've had the last 2.5 years, really, even though they've had very strong profits.
Very
strong. But as far as what really drives the economy, it's the number of units being sold. So you don't see any kind of hockey stick recovery in auto sales anytime soon, but more likely they're going to continue to stay soft, it sounds like.
Well, I think that there will be a few months, right? I've been waiting 2 years for this car, so it's finally there. And then I think the real issue is going to be, because we don't appreciate how quickly 2022 rolls over to 2023 models. But I think the 2023 to 2024 model rollover is when I'm going to be waiting there to buy my 2023 personally in cash. Because I think that we're within probably a 9-month time frame to where you're like, wow, things aren't going to get better in the auto sector. And they're going to be really weak. So, and by then I think the delinquency figures will be by far at record levels.
Good stuff. Okay, another question was from a longtime Haymaker subscriber, wanted me to ask you about the Eurodollar market. That's something he's been bringing up to me repeatedly, and I've said to him, look, I don't get that market. I have enough trouble focusing on the US market. But it is true that the Eurodollar yield curve inverted before the US market did, and it is huge. And I know you've got so this is actually Alhambra, Jeff Snyder, that he's really been on this thing. And he's been early, in warning that this is, forecasting trouble, but it's turning out that he's been fairly accurate. So what are your thoughts on that market?
So I think it's a combination of this is one of the prisms through which we see the strong dollar. And because there's so much dollar denominated debt outside of the United States that has to be refinanced, that didn't have the same stringent underwriting standards, that isn't backed by deep and old capital markets, established capital markets. And I think that that's why people keep saying, I keep saying, if there's going to be a credit event in the United States, it's going to be preceded by a credit event in Europe. Because so much of this underwriting was done in a very young, immature capital market backdrop, to say nothing of frontier markets of countries you've never heard of that were able to also access dollar-denominated funding in the last cycle. And that's again, it's the key that I just said is dollar-denominated.
Well, to your point, I just saw a stat that there's 25 trillion of dollar-denominated debt in the emerging market alone. in the developing world. That's a big number for those economies. And I don't think that included China. I think that was ex-China, but I could be wrong about that.
No, I think you're right that it's ex-China, and that might just be a snapshot of sovereign. Because if you look at countries like Turkey, they've got a ton of dollar-denominated non-financial corporate debt.
And an 80% inflation rate.
Oh gosh.
Not 8, but 80.
Oh, yeah. Well.
Those people are not bearish on gold like American investors are. They're very glad they had gold.
I wonder why. I wonder why.
Right.
I wonder why.
Okay, so you do agree that the Eurodollar market's important. It's big. It's unregulated. It's somebody I think said maybe this particular subscriber that, or maybe it was Jeff Snyder, that it's almost like this massive hedge fund, unregulated hedge fund, and that has the potential to pose systemic risks. And that's just another one of those things out there that is not great news for us in this highly connected, highly indebted world.
Especially with treasury liquidity being increasingly compromised.
Well, that's a very good point. We really haven't talked about, and that is, well, actually, now that you said that, one of the readers, John G, is worried that the U.S. Treasury market is becoming overwhelmed by supply. And this is partially due to the fact that you and I both think there's a recession coming, and we know what that does to deficits. Banks seem to be actually somewhat disgorging treasuries. Foreign central banks, largely. There has been a lot of buying lately, but what actually does appear to be the hedge fund community, which is maybe not the most, the stickiest of all acquirers. So, I mean, do you think that, because as you say, even though things are actually somewhat okay right now, there are signs of dysfunction in the treasury market as it is? So do you see that as really, could be another one of these major threats out there?
I do, and I won't say that I was surprised that Janet Yellen's Treasury Department didn't offer to try and enhance liquidity, because I just said Janet Yellen in the sentence. But I think that that's banks not wanting for the Treasury to become involved in the Treasury market. I think the banks want to hold on to that purview because central clearing of treasuries is a threat to them. And I think that that is probably going to be in the works, and that that's something that Jay Powell has his sights on. But no, I do think that treasury market liquidity, especially in issues where people don't want to give up their paper, so that it could become very, very problematic. And that's why I say things like securitization, things like asset-backed securities, things like commercial mortgage-backed securities, in situations when treasury liquidity is compromised and you've got quantitative tightening going on at the same time, and the US government is hampered in its ability to borrow more because its debt interest service costs are going up so much, because so much of the treasury has to be rolled over and it's in short dated paper with increasingly higher borrowing rates. So it's a devil of a combination.
Well, how about all the interest the Fed has to pay on the RRP, the reverse repo program?
That's a whole bigger,
reserves of the bank, they're paying almost 4% now in both of those. And I think between the two, it's about $5.5 trillion.
They're chalking up negative, they're losing money as an institution. Legally, there's a way to wiggle their way out of it. They're not technically legally insolvent because they can just defer those losses and send them as reduced remittances in future years to the Treasury. And they've sent obviously billions and billions and billions of dollars to the Treasury in the form of remittances when they were not incurring losses, just based on their massive holdings of Treasuries. And
I'm smiling just because I saw actually the other day that number's $1 trillion. They, cumulatively over the years of all those QE generated profits, they sent the Treasury $1 trillion, approximately.
Yep.
So that's another big swing factor. You're going from that to actually running deficits. And so, yes,
that's exactly right.
It's something. So this question is from Alex E, who apparently he's communicated, I guess, with you in the past, but you got a lot of fans out there. So he's asking what do you think is going to break first? Basically, the U.S. dollar or the U.S. Treasury market? We've already talked about the U.S. Treasury market. We really haven't talked too much about the dollar, which, you probably know this, on a purchasing power parity basis, it's about 35% overvalued, having a tough day today.
Mm-hmm.
But I mean, I guess I would say, is that a sign that, perhaps this unbelievable strength of the dollar is kind of coming to an end?
I don't see Japan or Europe really pulling out of their economic funks anytime soon. And again, I will reiterate that that even if China is beginning to reverse its COVID zero policy, it's going to be a process. It's going to be drawn out. It won't be instantaneously reflected in the dollar yuan. So again, I go back to the dollar being the most attractive horse in the glue factory, which was always Richard's favorite way of characterizing it. Is the dollar overvalued? Absolutely. What should take its place right now? Can't answer that question.
So kind of to Alex's question, is it possible that the two are linked? That if there really is serious dysfunction in the Treasury market, that could bring the dollar under pressure?
Well, it certainly could, but rising interest rates, which would reflect dysfunction in the Treasury market, would tend to benefit the dollar. It's a question of, what if we start to see long maturity yields fall, and the prospects for U.S. recession begin to be contemplated on a global level, and where do we go from there? So
in other words, if that happened, if you really started to discount a serious recession that caused the long end of the Treasury market to rally, to come down in yield, which would make the dollar less attractive in that way, that could actually bring about a weaker dollar.
That to me would seem to be the more obvious, because the other route is assuming that some, to me at least, it's assuming that some other part of the world heals faster.
Cool. Okay, we're almost done with the questions. Rex W wrote that you are brilliant. Thought you'd want to hear that one. And wants to know which emerging market countries are in trouble. We already talked about Turkey, but are there any other specific basket cases out there in the developing world that you would identify?
So again, I think that China has done a good job of bringing down its property sector. So when I look at how strong the Brazilian real has been, and how at risk fiscal policy is going to be because of the because of how their presidential election turned out, and because of iron ore is their second largest export. So I just don't see the property machine kicking back up into high gear in China anytime soon, because they've actually made progress on that front. I doubt that officials want to give it back. Are they going to continue to import soybeans? Yes, of course. Other foodstuffs. Will there be a potential inflationary spurt as we hear that China's finally going to be reopening? Yes, but I think that some exporting nations that have been indemnified by China in the past, that have seen their currencies not get hurt, are going to be, depending on what their exports are, that they will be at risk.
So it sounds like you agree with my thesis about emerging markets, is that you can't just make a blanket statement. They have radically different fundamentals. You could argue some are actually in better fiscal shape. And one of the ironies lately that I think you've commented on is that it seems like some of these emerging markets are actually running more like developed world policies, whereas so many of the developed world countries are running what we used to think were emerging market policies.
Right.
Like there's been this role reversal. And
well,
so I do think
see so many emerging markets, they did get out in front of this tightening wave, and they did have much more aggressive, relatively speaking, central banks. But that
very good point.
Yeah,
that's a very good point. Brazil's a good example.
That doesn't save them from the global recession.
Right. No, that's a very good point. Brazil they got up basically their Fed funds rate, they got it up to and above inflation in double digits, very quickly last year. Well, in fact, as you know, Mr. Powell was still printing money even until March of this year. So you brought up Richard. You said the name Richard, and one thing I wanted to point out to our listeners is that you were, a Fed insider for a number of years, and you wrote a book called Fed Up, which is very near and dear to my heart, a lot like my Bubble 3.0 book, which really points a lot of the blame on what's happened over particularly the last 15 years to the Fed, and enabling bubbles and perpetuating bubbles. And so this is from Frank, and he wants to know if there's potential for the Fed to wake up to these bubble-inducing policies that they've been following for so many years. Powell seems to get it, but I realize that's not the whole organization. Is there hope that they're going to finally accept blame and actually change the way they operate?
Well, let me put it this way. If Jay Powell is, if Donald J. Trump could not fire Jay Powell, then I think that Joe Biden would have an even harder time firing him for cause, since he did get 80 votes when he was confirmed. The reason I say this is because one man can have effective veto power, and he could change the way monetary policy has been for years if he gets the terminal rate up to, say, 5%, and then he only brings it back down to 2% and eradicates forever the zero interest rate barrier. Says we're never going back to the zero bound again. I mean, that would change monetary policy. He could say quantitative easing didn't work, so we're not going to go there again. So one person could recognize, as he did in October of 2012, and when you read those transcripts, when he'd only been on the Federal Reserve Board for a few months, he came on in June of 2012. If that person is still alive and well in him somewhere, he could reject going back to quantitative easing, and he could reject the zero bound.
Yes, I remember, Lon, you and I both had high hopes that he was going to be cut from a different cloth, but unfortunately, 2018 was not his finest hour. So what I don't think I even really explained when you said Richard, you were talking about Richard Fisher, who's the former Dallas Fed president, president, who you were, like, I think his #1 assistant for many years, well, several years anyway. So it's this is another question about, is the Fed going to change its character because of its many failures of the last decade or so? But I guess
you would have to have a complete regime change. You would have to have Congress vote in a lot more rational players, and I don't think that there are very many on the board right now, and who are appropriate to be. I mean, Michelle Bowman, Christopher Waller. There's just a few on the Federal Reserve Board, I think, who belong there right now, with deference to the brilliance of everybody who sits on that board. And you would have to radically alter how Federal Reserve district presidents are chosen so that they're more pragmatic. And that those are things that I think take a change in politics, change in the Federal Reserve Act.
Well, you just said politics, and that's what I was going to bring up, is that when you talk about kind of the driving force, one of my concerns is the Fed has become increasingly politicized. That it's lost a lot of its independence. I mean, Mr. Powell's working hard to get that back right now. But that, and then kind of my final point, and then I want to talk about you and your service, but this idea that, we all know the Fed's dual mandate, right? Of you mentioned earlier, low unemployment and contained inflation. And sometimes those work against each other, just kind of like what we're dealing with right now, where he's trying to get inflation down, which means he's going to get unemployment up. But then there's also a third one, supposedly, of maintaining reasonable interest rates, which is a nice vague title. But it's the fourth stealth mandate that I really wanted to kind of close on, which is, do you think that the Fed's stealth mandate, which is actually kind of becoming the overarching mandate, is to fund the U.S. government?
I think that is something that you could count on, as long as there was a Democrat in the chair. I don't think that Jay Powell thinks that is, at least if he's going to stick to who he is, I don't think that that's who he is. Remember, Ben Bernanke left the Republican Party after he left the Federal Reserve. And of course, Janet Yellen was as Democratic as they come, as was Greenspan. So I think we have to bear in mind who is at the head of the Fed right now. If Jay Powell maintains high interest rates, that is going to be a huge curb on the government's ability to run up a fresh, new, massive deficit.
But by having very high interest rates, at least high based on recent standards, doesn't that just make the recession deeper and create even greater deficits because of obviously shrinking revenue and increased entitlements and support payments?
If they're able to pass the legislation. But I think that a GOP-led House is certainly going to get its pound of flesh before enacting any kind of legislation that remotely resembles the stimulus type of spending that we saw in the aftermath of the pandemic, if ever in terms of giving cash away. I think that the political divisiveness in this country is so rancorous that before we have any fiscal spending of that kind, the Republicans are going to have to make a stand just because they can, just because they're so bitter after what's been done using reconciliation with a Democratic White House, Senate, and House.
Well, let's face it, in this country, we implemented MMT, modern monetary theory.
We did.
And it was really never approved. It just kind of happened. And you and I were warning it was going to create inflation, and other people were very vocal about that. Jeremy Siegel is another. And
it did.
We got it in spades. And I don't know, it's going to be interesting. I do worry about how the federal government's going to be able to finance itself over the next year and even longer. But hopefully the Fed won't become what it was before, which was basically just a debt monetizer.
It was an enabler.
It was. Well, Danielle, you've been fantastic as always. No surprise there, but tell our subscribers the best way to avail themselves of your services.
Sure. So we have a very reasonable retail product called the Daily Feather. It's all of $59 a month. And that is, it's a continuation of my mission of financial literacy that started with writing Fed Up, and it allows basically anybody to really be edified every morning. And then we have a professional level, eight publications per week, the QI Pro level, access to a private Twitter feed, a Bloomberg chat room, all manner of, the dashboard. And that's something that is for institutions, people who are running money, big RIAs. So you can find out about both of them at quillintelligence.com. And if you don't already follow me on Twitter at DiMartino Booth, they say it's a free college education. So please come follow me as well.
And it doesn't even require like student loan forgiveness, right?
Nothing. No, there's no moral hazard on my Twitter feed.
Quite the contrary.
Exactly.
All right, Danielle, thank you again. Have a good week and get some rest. You deserve it after this hectic week that you've had.
Yes. No more Fed week right now. Yes.